The March Fed meeting kicking off today with a policy announcement tomorrow. Joining us now with his expectations, Evercore ISI Vice Chairman Krishna Guha. Krishna, good to see you. So you expect that Chair Powell is going to flat out say that the inflation prints, I guess the services inflation we've been seeing, makes it tough to build confidence that disinflation is setting in, huh? Is the market going to take that okay?
So what I think is that Powell will have to harden up his tone some after the second now bad inflation print in a row. He'll have to sound a little bit more hawky. He'll have to sound a little less Goldilocksy. But, and this is the really key thing, that tougher tone will be applied to an unchanged strategy and an unchanged baseline. We still think the base case is 3 cuts this year. We still think the Fed intends and expects to go in June after having checked the data from March, April, and May. So tougher tone, same base case. My hunch is that the market will be okay with that.
As healthy as the economy looks, as sturdy as services inflation looks, and as active as the rest of the year is going to be politically, what would it take for the Fed to actually be able to cut 3 times this year from here?
So I actually think that June and 3 cuts is pretty sticky. So why? Fundamentally, I think Fed officials want to cut rates. They don't want to cut before it's responsible to cut rates, but they think they want to cut as soon as it's responsible to cut rates. Why? Because while there's a lot of uncertainty as to exactly where this neutral rate might be, I don't think anyone on the committee thinks that a rate of 5.5% is sustainable indefinitely in the U.S. At some point, they fear something's going to go wrong with the economy. And so I think they will look to bring that rate back down to the mid-4s at least, as soon as they have reasonable justification for doing so. That's an economic judgment, but by the way, it also works well with the political calendar. June, every other meeting, so June, September, December, that would mean the Fed can be on an autopilot glide path through what's surely going to be a toxic election season. They would like that if possible.
Yeah, and it's interesting to hear you talk about that, especially given the pre-Fed article we got from the Wall Street Journal from Nick Timiraos today, where he basically said, hey, Fed's less worried, less focused on a strong economy and sticky inflation, maybe more worried on holding here too long and recession setting in. It raises the question, and Tim Dewey over at SGH raised this as well. It raises the question that perhaps the risk here is that you see more cuts added through the dot plot, because it wouldn't take that many officials changing that with that view than fewer cuts in the dot plot. Your thoughts?
With great respect to Tim Dewey, who I think is a super smart guy, I think that's an overstatement of the case. I do think that we will see net dot drift upwards. I just don't, in other words, some Fed officials taking out a cut either in 24 or 25. My own base case is that the 24 dots are pretty sticky. That 3-cut baseline is pretty solid. I think there's a higher risk that you could see the median take out a cut in 2025. My base case, though, is no change to the dots in 24 and 25. I think there is an awareness that if they stick around for too long, they might invite trouble. But I think, nonetheless, the biggest thing that's happened over the last few months is this setback on inflation. They won't overreact to it, but I can't see them throwing the steering wheel in the opposite direction.